talk markets, earnings, and more is Shark Tank investor and O'Leary Ventures chairman, Kevin O'Leary. Well, first, Kevin, what are your thoughts on this earnings season so far? And is there anything that stands out to you?
I think the robustness of the earnings is what stands out to me, and the fact that the consumer has not rolled over yet also stands out. And you're hearing that from multiple sectors, whether it be, energy, technology. I mean, it's been consumer. I mean, there's been a lot of concern about debt and default, but the last credit card data this week showed how resilient the consumer still is, and defaults haven't passed historical norms. So it's steady as she goes. The soft landing is upon us. I think most investors feel that way. Lots of risks, global risks, war, et cetera, supply chain issues, all of that. But the market has continued to climb a wall of worry. And those that have remained in equities have been richly rewarded, even during volatility. Now, obviously, NVIDIA tonight is a big bellwether for the tech sector. And it's already corrected in the last couple of days. But if, obviously, this AI movement is driving a lot of growth in tech stocks because there's merit to it. It does bring enhanced productivity. So just how much, how fast is still unknown, but investors seem to be willing to bet the long side of it as opposed to shorting these behemoth stocks.
Mm-hmm. And we'll have to wait and see on NVIDIA there, but certainly a lot of attention there right now. Now, how should investors and advisors be thinking about opportunities in the current economic environment, Kevin?
Well, I think for the first time in over 15 years, the balanced approach seems to have, to be a good strategy, because if you thought about when interest rates were down at 2.5 to 3%, owning long duration fixed income assets just didn't make sense. And that really got people overweighted into equities. And so on an index basis, you could find lots of financial advisors going 70, 75% equities and the remainder in other assets. But today, when you can make 5% in cash and 7 to 8% in AA and AAA corporates, it makes sense to take on some. And I've certainly done that. I've gone back to more of a 60-40 approach, having been 70-30 for over a decade. And it doesn't mean I've abandoned equities, but when I start to see the debt side, the fixed income side, even T-bills, to me, it just de-risks the portfolio a little bit. And I don't think I'm the only person thinking about this. It's, where do you tiptoe in the fixed income tulip patch? And I like corporate debt. I have a pretty good portfolio of it, almost hand selected. I used to be a bond guy. I guess I still am, and a fixed income balance sheet guy. It's just I haven't honed my skills in over a decade, because I just didn't find any value there. But now I do. And so I've got my chops back. I'm reading covenants again, and I'm taking on individual positions in fixed income corporate debt, all the way down to single A, and getting anywhere from 5.5 to 7.5% on pretty short duration, 36-month, 5-year positions. I think that's interesting, and I haven't talked about this in such a long time. And so here we are. The markets, giveth and taketh, but now you have a chance to get a decent quasi risk-free return from fixed income again.
Certainly a lot of excitement once again in fixed income. And any areas within equities where you're particularly bullish?
I've remained bullish on tech, like everybody else, even though the PEs are very, very high. But I've started to nibble on energy again, and small cap in the Russell 2000, a subset of small cap in the Russell 2000. There's an index called OUSM owned by Alps. I had a say in how that was created years ago, but it takes out all the unprofitable companies out of the Russell 2000. So around 300 companies out of the 2000 that make sense. And the reason I'm doing that, and actually it's performed quite well, is if you look at the flow of capital, and I don't want to get into politics, but policy matters in terms of where you put money for the next 24 months, 36 months. In the last 6 months, you started to see for the first time fund flows going in to small and mid cap stocks, sort of $5 billion market cap domestic stocks. And that's what OUSM is made up of. oh, domestic stocks don't have international exposure. So you're not exposed to the Ukraine situation, the Middle East situation, but you are exposed to policy. So if you thought that the administration was going to change in the next 10 months, you would probably get the best bump by the deregulation in domestic policy. And at least 50 cents on the dollar from my take of it, which is why I participated, because nobody knows the outcome of the election. It's impossible to know. But there's a 50-50 chance the administration changes to a more pro-business, less regulatory environment, including energy, where one administration was against energy and the other is pro-energy. And so you're going to get this sector, which has been really good in generating cash flow, the energy sector, US domestic, freed up a little bit, like a balloon being held underwater. If the administration changes, you probably want to be long because I think the PEs will increase there. And that's one of my investment theses.
And you touched on a few of them already, Kevin, but what are the key risks for investors to be aware of this year, and anything you think could be flying under the radar?
Well, there's always the international risk. And I think people have been eyeing what's going on in the Middle East quite a bit, and obviously in the Ukraine. The border issue domestically has come to the top of the election narrative. These are all, on the minds of investors, particularly how it plays out. Politics is very divisive now. That's obvious to anybody. So there's a lot of volatility based on what you think is going to happen next. But I would say some kind of large escalation in the Middle East would be very bad for supply chain, bad for equities. Same in Ukraine. You've heard all of this rumor and innuendo about the use of nuclear warheads, but that's been ongoing with Putin for quite a while. The execution of the competitor there in the last couple of weeks. I mean, it's destabilizing, and so the noise level on that tends to get investors concerned. When I say investors at that level, I'm talking sovereign wealth and institution and pension, which are basically 70% of the market when you look at fund flows. So you have to consider yourself in terms of what they're thinking if you're an individual investor.
Finally, Kevin, what's the biggest mistake that someone could make with their money in 2024?
Is not to be invested. I mean, what I learned years ago, and it's so important that investors learn this lesson, the idea that you can time the market. I always find it fascinating when people say to me, well, I've gone all to cash. Well, why is my question. What do you know that I don't know? Is there some newsletter you read or some pundit that tells you you have to be in cash? People that try and time the market get punished pretty badly in this sense. Most often, market moves both up and down happen in very short time compressed periods. And so you saw that all through the pandemic. You would get 11% returns in 48 hours in the S&P. And if you were not participating in that, you missed half the year's returns. And so what I tell people, including, my associates that I work with and how we manage our own capital, is let's determine our risk profile by the amount we don't have in equities. So if we want to reduce risk, we raise cash, we get paid 5% to wait, but we don't sell all our assets in equities. We just reduce the amount we have. And right now, I'd say we're on the medium risk. We don't have that much cash because I like to put it to work, but we do have some, and there are assets because we do a lot in private equity and venture as well. And so, my rule of thumb is always no more than 5% in any one position and no more than 20% in any one sector. But every once in a while, and we have so many positions in our portfolio, I'll get a phone call in the morning saying this asset's being acquired, it's being bought out, or it's doing an IPO or whatever it is, and then we have no choice but to liquidate a portion of it. And that happens. That's just managing a portfolio. So cash builds, and then we work hard to find a place where to put it to work. And lately, the area of great interest to me, because I've always been a real estate developer, is this area of AI data centers. If you look at pools of capital being generated globally right now in the real estate sector, which remember is the 11th sector of the S&P 500, the most recent sector, it is for AI data centers. And these are really engineering complex facilities that are 80 acres in scope, and they require 1.2 billion for the shell and another 2.6 billion for the computer stacks. And you need fiber optics, you need power, you need permits, and you need politicians in these regions to support it. It's really complex, but these things are penciling out at 17 to 22% returns over a 20-year period because the tenant is generally Microsoft, Google, Amazon, and others, or the government, the IRS, DOD, and that kind of thing. And so I'm doing quite a bit of work in that area right now. And of course, that's where you try and find a state that has power, has fiber, has policy, allows backup generators. They're all required for this. And that's the competition of states going on right now, because what state wouldn't want 400 new tech jobs plus 5 new jobs for every one of those 400? So you're building a tech community when you build a data center.
Well, Kevin, great to have you back with us. And thank you to everyone watching. Once again, that was Shark Tank investor and O'Leary Ventures chairman, Kevin O'Leary. And I'm Jenna Dagenhart with Asset TV.